what strategies can you use? What do you need to know before you start buying? But allow me before that just to take you through briefly what ShareHub is about. So ShareHub is a platform that enables everyone to acquire knowledge and increase accessibility to the capital markets here in Kenya. So here at ShareHub, we are dedicated to give you the very best when it comes to learning, to playing, and then on your investment journey as well. So our vision is to enable active and empowered investors so that you're able to maximize your returns in the capital markets. We're on a mission to provide an informative and safe platform for you to learn and trade in the capital markets and to connect people with real investing opportunities so that you are able to fulfill your investment goals. So ShareHub is based on 3 pillars. We have the play pillar, the learn pillar, and the invest. So the play pillar is we use gaming approach so that we can make investing fun. We want to move away from the suits and all serious looks when you talk about investing. But so for us, it's making it fun, interactive, and intuitive as you gain your trading skills. Then the learn pillar is to give you real-time information that can be able to support you when you're making your trading decisions. So as you're making your trading decisions, you're making them from an informed point of view. And then the invest option, where now you're able now to go in and do actual investment for yourself. So I'll just go briefly through each pillar. So the first one, we can look at learn, and the learn pillar, we have 2. If you have time, please do go on to Google Play Store and download the ShareHub app. All this, as I'm going through it, it will be more familiar. So once you're on the ShareHub app, either on the web or on the app, you are able to get market news. And this is on our learn aspect. We have the market news and market information. And on market news, our aim is to keep you updated with the latest financial news at the palm of your hand. So wherever you are and you want to keep up with what's happening in the financial space, you're able to do that from the ShareHub app. Click on market news, and all current financial news, which we have sourced from reputable financial outlets, we consolidate them for your consumption. And then we have market information. This is also something else, because as you're starting to make your investment decisions, we want you to be able to understand historically where has the market been and all that. So we have included a section that has the current stock prices, the price changes, the volumes traded, the list of companies and their performances. And this dates back up to 10 years back. And all of this is available for you at an attractive subscription rate, just to be able to give you that ability to make informed decisions. So on the play aspect, we have Jikuze quizzes. Now, Jikuze quizzes is more of theory. We are trying to get you to understand the terminologies that are used when you start investing. And we've put this in the form of questions. So, and they're in levels. So each level has 5 questions. Then you get to, if you answer each of them correctly, you get 10 tokens. And then these 10 tokens, you're able to redeem them as you go now on to the games, which I'll talk about in a bit. And they're quite easy. But as you play that, then you also get to understand this terminology. So when you start your investment journey or you reach a point when someone will see a term, you'll be able to relate or to know what it means because you have gone through our Jikuze quizzes. Then we have our Zito Shares Challenge. This is a virtually simulated stock market game. And we have a challenge that runs monthly. So the game has 3 levels. Remember, simulated game is a virtual game. So it's in a virtual environment where you're able to test out your trading skills in a safe environment without any financial implications to it. So we have 3 levels on this, where you start off as a beginner and you have access to 15 virtual companies that you can trade in. What we've done is these virtual companies mimic the real companies that are listed on the Nairobi Securities Exchange. And then once you're able to grow your portfolio on the beginner, you advance on to the intermediate level. And then from the intermediate level, you advance on to the advanced level. Now intermediate, you get access to 30 companies, virtual companies as well. And then at the advanced level, you get access to 45 virtual companies to test out your trading skills. So if you're able to grow your portfolio by 10%, you advance on to the next level. And I remember I said, when you play the Jikuza quizzes and you get these tokens, you're able now to redeem these tokens on the Wazito challenge. Then this is our newest baby, our newest game. It's called Stock Street. So us at ShareHub are trying to get you from the virtual environment to real trading, but we want to give you a soft landing as you build your trading skills, as you build your confidence in now trading in the real stock market. So what we have done is we've introduced Stock Street game, and Stock Street is actually based on the NSE 20, the companies that make up the NSE 20 share index portfolio. So you have access. These are not virtual companies. These are real companies that are listed at the Nairobi Securities Exchange. And so we're trying to now move you closer to the real stock market investing. And we're also trying to make it even more interactive and intuitive, where now you have options. You can come and play as an individual. And then, just test out your strategies, see how your portfolio reacts, how you would do if you were to do it in the real market. But then we've also introduced the concept of coming and playing as a group. So you can come with your friends and create a private group, and you play against one another, challenge one another, learn from one another, and see, whose skills are working, whose strategies are working, and why have they worked, and exchange that information. And you also have the option of coming and joining a public group where you come and play against other people and see how you rank. You get to test out before you go into the real market. Am I ready enough now to start the real market in investing? Then we also have a league option, which now want to open up to the schools to come in and be able to play. So I think when you look at all this, we at ShareHub, we are all about creating financial possibilities. We are looking at it from the point of view that investing is a journey, and so we want to empower you to have all the financial information, financial literacy at your fingertips, so that when you're looking through that binoculars at your future financial possibilities, you can actually see a positive one. And you're seeing one where you're making financial decisions from an informed point of view, and you're able to create sustainable financial growth. So I think that's just in a nutshell, that's basically what ShareHub is. And again, thank you very much for joining us. Our contacts are here, and I think our team, our able team on the back end, will also be sharing more information on how you can be able to download the app, or if you have any questions, I think we'll be able to take some. But yes, we welcome you at ShareHub. We like sharing, just like our name is, and we share financial literacy information. We share any information that we have. We have on our YouTube channel, you'll be able to go and you'll get a lot of videos that you can watch at your free time and be able to improve your financial literacy at that. I think that for now, unless maybe there are questions that we can take. Or I can take this honors and introduce our guest speaker for the day to start off his presentation. Okay. Oh, hi Gishoi. Karibu sana, ShareHub. We are all looking forward to hearing what you have to share.
Thank you, Linda, and also thank you, Paris, for the introduction. I'm humbled. Sometimes I sit here and wonder if that was me, but always a pleasure to be of assistance, especially when it comes to financial literacy. And I am happy that ShareHub is doing this, because I'm a strong believer that information is the key. And value is the king. So value is the king, information is the key. So basically, I'm going to be talking about stock buying strategies. A lot of it is of my discussion will be a bit experiential, and with a few tidbits here and there about certain experiences I may have gone through in my journey as an investment advisor, as an analyst, and also advice and also helping a lot of people in their investment journey. I hope that this is going to be a productive discussion. Now, in stock buying strategies, I believe that the first thing that you need to be very, very keen on is, I believe that the one thing that you need to be very keen on is your mental state. Now, I don't know if, sorry, am I in presentation no mode?
No, just making full screen. Yes,
yeah,
yes, now you are.
Yeah. So I think the one thing that I found in my years as an investment advisor and in investment is that despite all the underlying things that we may teach you in terms of understanding the market and understanding the reports, understanding valuations, and looking at different graphs and ratios that you may have been taught about in terms of investment. At the top end, and the most important thing is investor sentiment and psychology. This is because the way you feel about investment and the emotions that come with investment. Remember, you're dealing with money you have worked hard for. It's money that you are now thinking, okay, I have my salary here, or I have my business here. I have made this amount of money. I've done my budgeting. I have my working capital for my company. I have enough for food and rent. And now I have some disposable income. And since I'm already thinking about retirement and maybe growing this disposable income, I want to start dealing with my passive income side of things. And so in as much as investment in the stock market is not entirely passive, you feel that you want to put money somewhere where it will start to give you, to work for you by earning you profits, dividends, or capital gains. Now, when you're dealing with money that you've worked hard for and you've put it in an investment, you will go through emotions that include fear, greed, and so many other things that can really impact your ability to invest in the market. I remember there were years when we had very good markets. A bullish market, which is when a market is going up, is a market that we usually say in investor speak that it makes even the dumbest investor feel like a guru. Because shares are going up, everything you buy a few days later, you're going to come and sell it and make a profit. But then come the bears, when the market goes down, for sustained periods, by over 25%. And sometimes that is likely to make you feel like just, hanging up your boots and leaving. And I always tell people, we are told that money does not, we used to be told when we were young that money does not grow on trees. That is true, but money grows like a tree. Money grows over time. It is slow, it is patient, it has ups and downs. There are periods when there'll be no rain, or someone will try to cut down the tree probably. So you're going to go through a roller coaster of emotions. Now, I usually begin my discussion by showing this photo. It's an old photo, as you can see, but for this generation, you can just look at it and imagine this would be some guys with dreadlocks, and some guys, with some shaggy hair or something. I don't know what it looks like today, but if these guys had come to you and said, look, we have this idea and we want you to, give us your money, your hard-earned money as an investment. My question is, would you have invested? Would you have given them your hard-earned money? I'm going to give you like 30 seconds. Go on the chat and say, what would you have given them your money to invest? If you can, tell us why. If you would have given them your money, why would you have given them your money? If you would not give them your money, why is it you wouldn't have given them your money? We're counting. Anybody out there? I hope you're typing.
This picture is very amusing.
Okay, did somebody said no? Nelly, why not? Why not? Oh, they look shaggy. Okay, you don't trust them because they look shaggy. All right. I would have given them my money. Rose, why would you have trusted them? They look innovative. Oh, I like that answer. It's the first time in my entire time of showing people this photo that someone has said that. Anybody else before I move on? One more. Anybody else? Okay, I'm going to work with the answers that I have gotten, and depending on your idea, yes, I like that. Depends on the idea. Irene and Elingero, depending on the idea, I agree with that. Well, I think I usually say when we're talking about money, there's never a wrong answer. But the question I asked was really to look at, or just to see how differently our emotions will affect us when we see this photo. I'll give you an example. For those of you who may be religious like myself, have you noticed that if you meet some guy preaching on the street, he's wearing some funny, clothes, his shoes are dusty, he has like a speaker which is even making, not very clear. We don't tend to stand around and listen to him, do we? But when we find this guy in a huge car and, very fancy suits and, he has even bodyguards. I think today I've seen even pastors walking around with bodyguards. What happens? We think that guy will lead us, direct to heaven, isn't it? So again, we associate looks, we associate what we see with what we are going to do. I like the answer that they look innovative. In fact, I think that was a very correct answer, and somebody said depends on the idea, because good investments don't come dressed in suits. What I'm saying is that usually the best investments don't look that good until you dig a little deeper. And that's why you've been talking about, the valuations of companies, etc. Sometimes we say if somebody comes to you with a very big, very well, book with very many nice glossy pictures, chances what you're buying in a market, we say buy the rumor, sell the news. Chances you're buying something that has already peaked. And yet when you see something that's at idea stage and something that is unusual, and these guys happen to be some of the richest guys in the world today. This is actually the iconic photo of the guys, the first employees of Microsoft. That's Bill Gates there, that's Paul Allen there, the two founders, and these other guys are the programmers. I think she was the one who was doing the an advertisement for Microsoft we see today. And this was the same time that people like Steve Jobs were walking around campus barefoot, talking about, putting a computer on a desk when computers were in huge 7-story buildings. I think it was the ENIAC then. I remember I was a computer guy in the early days of computers, and that was one of the things we learned. So that said, a lot of the time, it's not what we see, it's what we hear and understand and listen to that can drive us, because when we are driven by emotions, we are likely to make the wrong decision. When we look at something on the word go, it might look very good. And we always say, if it's too good, then you need to think twice. So talking about emotions, is my screen moving?
No. Have you moved on to the next screen? No.
Yeah. So
yes,
I moved on to the next screen. Okay. Now, markets move in cycles, and this is something that happens globally. It is not something that will start now. And when we say markets move in cycles, it's because you're going to see a lot of what we call volatility. And Warren Buffett there puts it very well. He says most people get interested in stocks. And when I talk about stocks, it's actually all investments when everyone else is. Think about it. When you're watching the news, Now that the markets are down and everything, have you noticed you have not been hearing a lot of news about the stock market? You know, you've not been hearing a lot of, hype about the stock market. And yet, when the stock market has gone up, and you remember when Safaricom was coming to the market, and that was probably when the market had been very good for a while. Everybody else, the headlines in the newspapers are stock market billionaires make billions, in the stock market, and everybody wants to be in the stock market. So now this, incidentally, is probably not the best time to be getting into a market. If you go and look in the past, you'll notice that 90% of the biggest companies list on the market. When we are at that point, we call euphoria. You see that guy at the top there shouting and screaming his high, how great he is at investing. This is when most companies will come and list in the market, because that's when people are most likely hearing the best news about the market. That's the best timing. That is when people will all come to the market. I remember when Safaricom came to the market, I happened to be quite new in the market. That was 2008. I had been an analyst, a research analyst for 2 years, because I started in 2006. And as an analyst, I hadn't gone into the business development and sales side of things. And as an analyst, I remember asking a lot of clients who asked me about Safaricom. Well, Safaricom is fundamentally a very sound company. It is a beautiful, value-wise, it was a very good company to buy at the time. It was the biggest company, most profitable company. It had the biggest market share in mobile telephony. It had a great future, considering that it was a technology company and tech was the hype then. But my question was very simple. If everybody is buying it to sell it, then who are you going to sell it to? So chances are, in as much as all the other information about Safaricom, the fundamentals were right, the issue was who was going to buy from everybody. Because I remember I had to hire. I was also dabbling as the IT administrator at that company at the time where I was working. And I remember we had to hire like 20 computers to be able to take all the new accounts that were coming. Most brokerages had people standing around the street corners, long lines of people trying to become to open accounts to go into Safaricom. And what happened immediately after the Safaricom listed? Safaricom listed at 5 shillings. 2 days later, Safaricom share rallied to 8 shillings. Clearly, there were people who wanted the share that did not get the share and wanted to get the share. And so they pushed the price up. There was a lot of demand. We called the same investors and said, okay, take your profit. You've made 30% in 2 days. Actually, 60% from 5 to 8 bob, 60% in 2 days. So sell. Would you guess what they told me? Most of them said, because it's gone from 5 shillings to 8 shillings, then it's going to go higher. So they said, no. But a few months later, Safaricom then came down in the same cycle you're seeing here. Foreigners had a lot of shares, started selling them. And so investors went into anxiety. Oh, could I have made a mistake? It was back at 5 bob, denial. Then you end up in fear. And right now, if you look at our market at the moment, we are somewhere around here. Capitulation, despondency, and depression. Because a lot of shares, if you look at them, somebody who bought Safaricom, which was a great buy mid-2022, or towards mid-2022, somebody who was buying Safaricom at, in the 30s, because they expected it to go higher. I remember it peaked at around 44. It is now trading at around 16 shillings. So you can imagine you've lost money on the best company, the most profitable company, just because there's other things that are happening outside of course, there is a lot of geopolitical risks and geopolitical things happening that are causing shares to go down. So I couldn't overemphasize the effects of, I don't know why my screen is not changing. I couldn't overemphasize the effects of your emotions on your investment journey. But your biggest enemy in terms of emotions are fear and greed. Now, but before I go into that issue of fear and greed, I'd like to maybe put to you that we have a market is made up of three components: buyers, sellers, and undecided people. As I ask the question, who do you think is the most important in these three people: buyers, sellers, or undecided people? Anybody? Let's answer quickly in the interest of time. Among the buyers, sellers, and undecided people, who would you think is the most important in the market? Undecided. Thank you, Irene. Why? You didn't say why. Undecided. Why? Why do you think it's the undecided? The sellers. Nelingero says the sellers. Thank you. Anybody else? Somebody says all. Yes, they are all important. I just wanted to know who's the most important. Well, they can shift the market any side. Thank you, Irene. And I think, Irene, you're correct in your answer. That's great. I wish you were here. I would have given you a spot award. Yes, the undecided person. Now, note, when you're walking into a market, right now we are not in a market. So it's quite easy for you to look at it and see, yeah, it's the undecided people. But remember, your interest in the market is what governs your view of who's more important, the seller, the buyer, or the undecided person. If you're the seller, then the most important person to you is probably the buyer. Why? Because you're coming to sell something. If I'm going to Nairobi, which is a market, to sell something, my worry would be who will buy it, or will there be buyers? The same applies to buyers. If I'm going to buy something in Nairobi, my interest will be where will I find somebody selling what I want to buy. But the undecided people, look at it this way. That's why we preach to people. That's why we have politicians doing campaigns, because the undecided people can become a buyer or a seller. So when you're investing in a market, your key thing would be to watch the undecided people. Remember, there are also buyers and sellers who are undecided on whether they buy or sell. So undecided people can be anywhere in this whole spectrum. And if you can tell what undecided people will do, whether they're going to sell or buy based on the information you have. Imagine when COVID came, if you had realized that foreigners would want to run back to their markets with their money, it means they would be selling. And since they normally hold over 70% of shares like Safaricom, then what will happen? The shares will go down. So at that point, you sell your shares, wait. And then what happens is when the share has gone down significantly, then you can come back and buy. A period like now, when Safaricom, from about 70% ownership in foreign hands, now only 7 or 8% is in foreign hands, which then tells you that you can see why Safaricom has stagnated and is probably going to start going up. So yes, the company has gone down from 44 to wherever it is. Why? Not because there's something wrong with Safaricom, but because there was something external that was affecting it. And you need to be on point in trying to figure that out. The other one is fear and greed. Greed is easy. I've already explained it. People who didn't sell Safaricom when they had made 60% in 2 days didn't make sense. So again, never buy something you don't understand what you're willing to sell at. Again, never buy anything if you don't know what you're willing to sell it at. So then you know the value of what you're buying. Yes, we're going to talk about the different types of investors as we go along, but at the same time, it is always good to know that if I bought this car, I'll give you a story. I have a cousin who once went to the car wash. He had bought this Toyota Prado, which is the older version, the more classic version. He's having his car washed, and a lady comes in and she sees the car and says, I've been looking for a car like this. And he says, make me an offer. And he came home in an Uber, because the offer he got, he already knew this was enough for him. And actually, 2 days later, he bought the newer version of the Prado. So again, guys, you need to know what you're willing to sell it at. Otherwise, you're going to lose a lot of opportunity. The other one is fear. Question, what do we fear when we invest? What do we fear when we invest? I'll give you 10 seconds. What do you fear when you invest? 1 or 2 words. What do we fear when we invest? When you put your money in something, what do you fear? Loss, losing money. This is the classic answer. But ask yourself this question: if we fear losses, why do we tend to get into businesses when they're most expensive? Look at quail farming. Yeah, guys started quail farming, blah, blah, but then eventually everybody wanted to be a quail farmer. I remember seeing those eggs, they look like paperweights in the supermarket. And I asked somebody, what are these? And they said to me, oh, quail eggs. At that time, they were like, I think 30 bob an egg. A few days later, I go past the same place, they are 100 bob an egg. When I asked somebody, they told me, hey, I thought you're a good investor, but now you don't even know about quail eggs. Everybody went into quail farming. Then what happened? Of course, now the market got saturated and everybody had quail. Suddenly, quail eggs fell in value. But look at it this way: if you got into quail farming when a quail egg was 100 bob, then whoever was selling you the quail would have sold you the quail at a premium, because he's selling you a bird that will give you eggs that will give you 100 bob an egg. So what happened is that now, when the quail eggs value, the next time I saw them, there was a guy selling smokies and there were quail eggs. And I was wondering, hey, hata watu wa stage sasa wanakula quail egg. So what happened is, everybody who had quail eggs, and I usually, when I'm in a room, I ask, who did quail business? Nobody puts up their hand. Why? Because they now are stuck with quail, they are feeding them, but the eggs, based on how much they bought, it's not profitable to sell that quail egg at 10 bob. But the question would beg, do you think quail business would be good right now? Yes, because there is a market, but nobody is keeping quail anymore. So you can probably get in. See the cycles again. But the fear we have is the fear of missing out. Even a matatu makanga knows that. When you stand at the stage and a matatu comes and there's no other matatu, what do? They tell you, ya mwisho mia. Why do you get into that matatu? So again, we tend to get into investments. Why? Because an emotion has been triggered. An emotion that we are going to lose out if we don't buy at that point in time. So you need to be very keen to ensure that if you're going to get into an investment, you're not being guided by fear or by somebody telling you, if you don't buy it now, you'll never gain. So generally, what you're looking at is what triggers your buy, hold, or sell decisions anytime you're investing. Now, in order for you to come up with proper buying strategies, you need to do what we call a risk profile. Now, how does a risk profile work? A risk profile will tell us, based on your age, because when you're younger, then it means that you can invest for longer. And if you can invest for longer, it means you can take more risk. So chances are, if you're younger, you have more time to learn from your mistakes. You have more time to earn money. If you lose your money, you can get up and start over again and go out and try to earn money again. So there's a lot of things that work for you when you're younger. And for that reason, what you're going to be buying when you're younger is very different than what somebody say, my age. I've noticed people calling me Mbaba these days. So people my age will probably be looking for less risky, more stable investments that earn us not necessarily a high return, but that is just an age thing. But that doesn't mean that someone like me, if tomorrow I inherited a lot of money, I might just go and start behaving, just buying and being very speculative, because I'm not very scared of the risk. So time horizon is a very important thing. How much knowledge you know or you have about investing is important, but I would really advise that even as we are looking at how much you know, this is something that will change over time. So when you start, your risk profile will show that you don't have much knowledge, but over time, of course, what will happen is you learn as you make mistakes and you make profit here and what worked and didn't work. So that is also another important metric. The other metric that we look at is how you handle risk. How do we find this out? We will ask you some generic questions. If today you put money in something and you lost 50% of the amount, what would you do? Maybe you can answer that on the chat. If today you put your money in something, you bought a share, for example, and in a week it's gone down by 50%. What would you do, and what would guide what to guide your, aha, I like that. Hold, all right. Re-strategize, that's a good one. Thank you, Nelinjeru. Anybody else? You put your money somewhere, you've lost 50% in a few weeks. Depends if I had 50% to spare, all right. It's your disposable income. If the stock has got good fundamentals, then I will still hold. I like that. Thank you, Nelly. So yes, the strategies and the difference in how we react. You'll notice that especially for employed folk, we are used to that salary coming in, we're used to safety. Employed people will tend to be a bit more risk averse. I think most of us in here are younger, so I've noticed you're willing to hold, you're willing to wait. There's something we call dollar averaging, then you can buy more and reduce as the price goes down. You buy more shares, which brings down the price you initially bought at because you're diluting the price, so that when the share price goes up, you're not sitting at the top of the hill. Now imagine somebody who bought last year Safaricom shares at 44, which was the peak. The share has been coming down, it's now 16. If they just sat on the ones at 44 because they've lost, then they have to wait until Safaricom gets to 44 for them to buy back. But if they kept buying, of course, it's dependent on how deep your pockets are, but it also means that when you diversify over a period of time, then it means every month you're putting, say, 2,000 shillings, or 5,000 or 3,000, or depending on your ability. Over time, you'll find that that 44 bob maybe has come down to something like 30 bob, or 15 or 20 bob, depending on how much you are adding onto it, so that when the share price starts to go on, you'll be coming back into profit earlier rather than later. But yes, I agree with your answers. It's good to first look at the fundamentals. If the fundamentals are right and the reasons it has gone down, which are external, which means once all these geopolitical things end, then chances are it will come back. But anyway, I'm going into my other side of selling shares than the teaching. Anyway, so your goals and your objectives are the first thing. Why are you investing in the first place? The next thing we're going to be looking at, please bear with me, sometimes my slides are refusing to change. Okay, there. So you can be the kind of investor we call speculative. These are short-term investors. Now, short-term investors are very different from the longer-term investors, and this is why. A short-term investor is more speculative. Now, if you come to my office and you ask me to advise you to invest in shares and you're looking to make money in 3 months, I usually tell you, dude, just go weka dartboard, uandike makampuni, throw the dart, pali itagonga, weka pesa, and then see what happens. Because fundamentals don't work in the short term. They work in the longer term. So if you're being speculative, then what you'll be using very much and a lot of the time is what we call technical analysis, meaning you'll be looking at graphs and looking and seeing that a certain share has a certain pattern. It usually goes up because when some people even tell you on Mondays, and then on Wednesday it goes down, and you're looking for short gains. Again, speculative can be, maybe you're looking at let's think about something like, it's an election year. In an election year, you're thinking people will tend to use their phones more because they will not travel. So chances are the airline share, Kenya Airways, will go down during that period, but the telecom share will go up. So you sell the airline share before it goes down, buy the telecom share, and then towards the after the end of the elections, then what do? Then the telecom share will have gone up and you go back into the one that went down, which was the airline. So you're looking at different reasons of why something might happen that will cause those dips. Of course, speculatively, it might just be a books closure, that the books are closing tomorrow, and you think that if the books close and you sell immediately, you will get the dividend, and maybe it'll have gained or it'll have lost less than the dividend. So you want to take advantage of that. We have also value investing, which is another type of investing. There are several types, and we may not be able to cover them very deep with the time that we have. But generally, what happens? What happens is that in value investing, what you'll be looking at is those companies that are underpriced. You want to buy a company that you feel the current valuation of that company is lower than it should be. And I would think right now, if you look at the market, you're going to see a lot of them. You're going to see a lot of those companies sitting on the market, because right now, something like, and I'm just going to keep using Safaricom. When it was at 44, our valuation, our target price was 36 shillings, because techs will tend to be overvalued by the market. Now it's at 15, it is still at around 30 shillings in terms of our valuations. It's come down because of the issues, say, we expect to see in Ethiopia, etc. And before that business kicks in. So generally, you're looking at that company that you feel is underpriced. You want to put in your money when it is low, because you know that once the fundamentals begin to work, that share price should go up. It will become a very profitable company, and you can get some money or a good return. I'm going to hand over to Paris at this point and give her a chance to give us a bit of an insight before we move on.
Thank you, Samuel. I'll just maybe take a question that I've seen on the chat. This is from Wycliffe, who is asking, how does one identify that a certain stock has a high number of undecided shareholders? How does one identify that a certain stock has a high number of undecided shareholders? As you're pondering on that question, before you respond, I'd also just like to mention that we're having surveys ongoing. Please help us be able to curate these webinars to be able to fit what you want to learn. And also just maybe pointing out, so that even as the speaker is responding to the questions or the comments, you can be able to identify who exactly has commented. Please, I'm urging you to rename yourselves. Gishohi, kindly, the response to the question.
Thank you, Paris. How does one see? Well, the fact that they are inside the stock or they have already bought it means they were decided when they bought it. Why would they be undecided? You'd probably think that there would be indecision if there was an externality or an external factor that was affecting that stock. And it means that then those shareholders will need to decide that whether based on that information that they have, will they decide to sell or to hold the stock. I'll give you an example using the next slide. There is a type of investor. My slides keep refusing to change. Okay, there. An income investor is an investor who's looking for dividends and some capital gains. So they would be very happy if they bought a share and it went up, but they are also interested in dividends, which means they're looking at how the company shares their profits to shareholders. Now, a dividend investor will buy a share as long as they are feeling that this company has a dividend policy that pays dividends consistently. Now, if something happens and that company decides that they may not pay dividends, and I'll give you a very good example. Just during COVID, and just before COVID, Equity Group decided to go into the DRC market. Now, it was a very positive move because a lot of investors thought that going into the DRC market would be a new horizon. But then immediately after that, COVID happened. Now, when COVID happened, Equity was going to do a big capital expenditure in Ethiopia and also expected to see a deterioration of their loan book because there would be more people being unable to pay their loans. So Equity Group announced that they would not pay dividends. Now, that means that somebody who had decided that they were going to hold onto Equity for a period of time because of the dividend yields that they were getting from Equity would have immediately felt that I don't think I want to be sitting here because, one, share prices had gone down because of COVID. Nobody knew when COVID will end. Two, the dividend issue was something that had cost them too. make a decision to buy. So now immediately they move from being decided investors who have decided to hold equity to trying to make that decision on whether to buy or sell. And chances are, if I'm watching that share from outside, I would look at it in this way. Equity has a great history in its ability to go into new markets. They have penetrated new markets and done very well in the past. So I wouldn't expect that not to be the case this time. Equity Group is very good at their loan collection system because of their ability also to have very good risk issues. So as a company, they have proven themselves. So for me, and at that same point, the share price had gone down because of COVID. So for me, immediately, not having been somebody who would probably have bought equity before that, I would immediately have decided this is a good buy for me because I am a value investor. I think that now that company has become underpriced, and I feel like if I buy it now, I can sell it. So again, and thank you that very much for that question, because it has given me a way of at least explaining the difference between this value investor and the dividend investor. Now, then there's another investor who's called a growth investor. And this growth investing is again another level of where I'm looking at future growth potential. Now, remember earlier I said that a lot of the time markets will overvalue what we call tech stocks. Why do markets overvalue tech stocks? The same reason that people would have given, somebody said they would have given that group of guys at the beginning of this discussion their money. They look innovative. So if you feel that innovation and you look at a company, it's in the tech sector, and you see that in the future it is going to grow huge. And if you look at some of the investments people make, a lot of the time, tech stocks, and you remember we had the dot-com bubble at some point, tech stocks show you a great future and great things that are going to happen in the future. Right now, the big thing is AI. So chances are a company coming into the market and it's very strong in AI will tend to say to you huge growth potential, and you want to buy it because of that growth potential. So all these choices in terms of buying, hold, and sell are all based on what your way of thinking. One of the other investment styles that I would, or investment options that I would like to also mention is when you're investing as a contrarian. Now, contrarians go against the market. Earlier on, I just received a question from one of my clients, and they said that somebody is saying that they expect the recession in America, a recession to happen in America, but they expect the US will reduce interest rates, which I personally don't. And that will cause a huge, change in global markets. So they're buying based on what they think will happen, and going against what everybody else is thinking. Now that's also very speculative, but when you do that and it works for you, you can make a lot of money when you're making, if you make the right decisions. So again, when making a decision, let's just go through some of the things we've agreed. Check your emotions. I can tell you for a fact, emotions are the biggest and most damaging thing. Let it be business. In The Godfather, I remember The Godfather, the movie, he said, this is not personal, this is business. Think about your investments as business. Yes, businesses can make losses, but stop putting it emotionally, because sometimes you end up holding on to things you shouldn't be holding on to. You end up using things like rules of thumbs where you say, as long as the PE ratio is above this, that's when I buy. But you're not looking at the sentimental side of things. What is happening globally? What is happening? How does it affect my stocks? What is happening in the finance bill, for example, right now? How is it going to affect my stock? Are we seeing more sin tax? Is it going to affect, say, things like EABL and BAT because of the kind of business they do? And then based on all these things, you can be able to make a decision. Now, remember, it's also very important to also have understand the longer term, medium term, and the short term scenarios when you're looking at something. In the short term, you can see very high volatility in the stock market and in whatever investments you're holding. But in the long term, the volatility, and when we talk volatility, we are talking about risk. So risk in the long term is much lower because over the long term, the risk smooths out. So if you're buying in the short term, then chances are you can either lose a lot or you can gain a lot. And this is usually between 0 and 5 years. Now imagine somebody who got into the market 3-4 years ago. Right now, to them, this is the worst place to be. Why? Because the market has, right now, our market is about between 30 and 40% below where it was 3-4 years ago. Now, if that client has kept investing and buying, then it means they have already reduced by averaging down, like I explained earlier, they've already reduced their losses maybe to something like between 10 and 20%. Now, over time, when markets start to recover, assuming that these shares now start to recover, and we assume or hope that 4 or 5 years or 3-4 years from now, this whole Ukraine war thing, geopolitical risk, de-dollarization, and all that will have gone away, chances are then we will have gone back into profit. So in the long term, you will tend to see that based on the different strategies that you make in buying and selling and using the right ideas or the right information in the right way, then you can be positioning your stocks in the right place. So again, give your investments time to cook. Now, I know people always say, oh, invest for the long term means I buy KCB shares and hold them for 10 years before I make any decision. That's not what long term means. Long term means that you're an investor for the long term. Restructuring your portfolio, buying and selling to restructure your portfolio for the highest possible return in the long term is what long-term investment is about. So let not the word long-term be that it's because you're holding something for all those years. It just means you are holding your money in shares, but then when markets are bad, you can move it to bonds. When markets get good and interest rates again go to where become low, that you can move back to shares, move it around, and that is where we come in as investment advisors. So again, I usually like finishing my my presentations with this. This is a day in my life, really, and you can see a guy on the top left-hand corner. That's me before or after I get my bald head. It's not yet here, but that's me there calling one of my clients and saying, "I've got a stock here that could really excel," but somebody is listening to what I say because they probably think I'm an expert and I can tell the future. And what they hear is the word excel. By the time it reaches the fourth guy, people are selling. Now, remember, I was calling somebody to tell them that I think a share will do well. But now they are selling. You can see me down here. I've now put on my hat and I'm saying, this is madness. I can't take it anymore. Goodbye. Same thing happens. Now they are buying the same stock. And so in one day, I don't know if this was a day or a few days, everything is going exactly the opposite of what I was thinking. Why? Because the market was being moved by emotions and not fundamentals. The reason I was making this initial call might have been because I had looked at fundamentals and seen that this is a value stock. I had the information. But these guys were working on rumor and hearsay. Now, that's why I am here again, somewhere at the bottom right-hand corner, and I'm back in the market, and I'm again trying to tell somebody, I've got a stock here that could excel. So at the end of the day, value is king, but the information you have is the key. But information is not just the market information. It's not just the balance sheets. It's not just those PE ratios and those things. No, or those models. We have even investors who use algorithms. It is not the graphs. It is not just the news that is coming out, geopolitical risks and de-dollarization. It is all that encompassed. And if you are able to look at it more holistically, then it means even when we are giving you our reports, you're going to look at it from different sides of the coin and then make a decision based on information that is going to affect from all directions, and you can end up making very good decisions. But remember, with value and information, as long as your emotions are in the wrong place, you will continue to make the wrong decisions. Thank you very much for listening to me. I hope we have gotten some insights on investing. I know and I believe we will, this has set the pace for future discussions, and I'll be very happy to take those discussions up with you going forward. I believe that the Share Hub team will be sharing my contacts. You can call me, email me, and I'll be very happy to assist you. Thank you, and back to you, Paris.
Thank you, Gishovi. I've actually pictured that board in your office. So yes, this has been really insightful, and we'll take the questions that are on the chat. We have 2 questions, and I'll encourage people to post their questions and also add at the end of it your name. The first question is, if you're looking at long-term investment, how does one choose between selecting dividend stock and growth stock? The second one is, how do you determine which stock to reinvest your gains instead of collecting the dividend yields? That is from Bugwa. The second question is from Bugwa.
All right. Very good question. How do you determine a dividend stock versus a growth stock? Now, a dividend stock, what we call defensive stocks, will have a tendency to be to have been there for a long time, have a lot of very big market share. It will have very big reserves. It's not expanding much because it's already, settled in that big market share space. And so it means that it's what we call a cash cow. They make very stable. It's very stable in terms of its profitability. Chances are it will also be a utility. Now, the reason I am a bit in Kenya, that can be a bit different, because I think in Kenya we are one of the few countries that have a power lighting company that makes losses. I mean, why do you lose money when you're selling electricity and you're just putting it in houses and charging bills? But that's a political issue. But that said, defensive companies will sit in that space. I'll give you a live example so that you can see the difference between a growth stock and a defensive stock. Around 2000 to 2010, if you had been in our market, the biggest and the most successful banks in Kenya were Barclays Bank and Standard Chartered. Barclays had become so big that they had even gone and told people, if you have a balance of less than 50,000, just move on. They had even closed branches. I remember a branch like Nyahururu, they even closed it and told people, now if your branch was Nyahururu, you'll be going to the bank in Nakuru. So that was a company that had reached a level where they were successful, they were big, they were, huge. Now, what happened after that? Around that time, we started to see the likes of Equity Bank coming into the market, and it was a small bank, was accepting anybody to open accounts and everything. So what happened? Barclays was a defensive stock. It was at its peak. It was paying very good dividends and continues to do so even today, because it's not that it lost its market share to the likes of Equity and KCB. It's just that it has that niche, customer who are the big corporates and a lot of bank, probably government accounts, etc., which means it has reached that point where it was a cash cow. But these smaller banks, the Equities, the KCBs, were expanding and growing very fast from what Equity had been was what were they calling it? A building society, from helping women get to cash their bonus checks to what it is today. So, and you can see even today, they still continue to be growth stocks. Why? Because something like Standard Chartered and Absa are within Kenya, because they are. It's a global bank, but Absa Kenya is Absa Kenya. It cannot move to Absa Uganda and all that. It is Absa Kenya. So the shares we buy are for Absa Kenya. Now, if you are, say, on that equity end, they are now moving to DRC, they've moved to other, so you would be buying the two shares probably for different reasons. You're looking at that bank which is going into new markets as a growth stock because the company is growing, and the other one which has very good market share and still pays good dividends. I'll tell you another one, something like BAT. BAT pays almost 100% of what they earn in dividends, and I don't think we're increasing our cigarette smoking. So, but cigarette smokers will smoke whether you tell them to go in a hole or where, they will still smoke. So generally it becomes defensive. So that is one of the things that would give you a difference between a growth stock and a dividend stock. The other thing would be the type of business they do. As I said, if it is a utility, then chances it will be a very good dividend payer. The other question was very.
The second question was, how do you determine which stocks to invest, to reinvest your gains instead of collecting the dividend yields?
Yeah, and that's a very, very good question, and I'll tell you why. You have just brought in the concept of compounding, which is try to always reinvest. Remember, we said you're an investor for the long term. So if you get dividends, if you spend that money, then it means you've taken it out of your long-term investment plan. But if you reinvest it, it means next year you're going to earn dividends on dividends. But what will happen if the company that you're already in is slowing down? It is probably not growing that much. Maybe it has already reached that point of saturation where you feel it's becoming defensive. It's paying good dividends, but you want to take more risk with the dividends. And then you can look for another stock which you feel is a growth stock, as I said, and start putting money in that, because both of them serve a purpose. This one is giving you good dividends. You're putting those dividends into a more risky stock, but which gives you more chances of both dividends and capital gain. So again, it's a very good strategy. Your question is actually a strategy, if you look at it more closely, because it just says reinvest your dividends, but not necessarily in the same company that give you dividends. Reinvest them in the company which, say, at that point in time, you feel is at a lower price. So you're taking dividend investing, which we call income investing earlier, and trying to now make it into value and growth investing, because you're now looking at what is undervalued and gives you the highest chances of growth, which means that is capital gains. So what you've actually given us in your question is a strategy, which means we are learning very well in here. Thank you.
Let me just chip in as well, because I think this is a question that comes in from most people who, when they start talking about reinvesting dividends, and people always ask, so is there a way that when I'm getting my dividends, it just goes directly into my brokerage account so that now I can just reinvest it from there? Because at times when it comes through to your account, inapata miguu, like you end up spending. But I think it's also some element of discipline when this is, I'm expecting this dividend, and that's why when the companies announce, they'll announce everything, including the dividend payment date. So when you receive that money, if you are the kind of, you'll move it to M-Pesa or, go cash it, and then you say, I'll pass by my brokers, or, I can and deposit it there, then just be disciplined enough to move your dividend income into your brokerage account as soon as possible, so that now as you decide what buying strategy, what am I going to buy? Do I buy more of this? Or, as Gishui said, do I now look into buying a different stock that's going to complement this one in terms of future dividends? So as at now, we don't have the ability of being able to just have your dividend credited into your brokerage account for further reinvesting. It comes directly into your account. So you have to be now the one to do the redirecting for you to be able to reinvest it.
Thank you, Linda. Just a comment. Someone said, be nice to Barclays. It's a CNR company. It's a CNR customer. Well, I guess that was more historical information. I have nothing against Barclays or Absa. It is a great company and they pay great dividend. Actually, one of the best dividend payers in our market. And they have, of course, reinvented themselves and done very well over time.
Thank you for the responses. Do we have anyone who'd like to come on live and ask a question? If you do, we don't want to lock you off. Kindly raise your hand and I'll move you to a panelist for you to ask a question. I'll give about 30 seconds. If there's no one, I'll call the guest speaker, Samuel, to just give the vote of thanks before we close. We don't have any other questions on the chat. Don't lock out anyone. Any questions? I've seen one question, one person. I'm adding you in a minute. I've unmuted you. Kindly ask your question.
Yeah. Good evening, everybody.
Good evening.
Good evening.
Yeah. My name is Philip. I understand that it appears like I'm Irene on the platform, but I'm Philip, and though today we are talking about shares, I had a question about the money markets.
Go ahead.
The money markets. Do we invest the same way as you've shown us, that it has like a cyclic motion where at times it goes high and at times it appears low? Or how do we invest in money markets?
Right. Thank you very much for that question. It's a very good question. Money markets, and I'm going to assume that, or maybe since you're still online, money markets can mean two things. We have funds that they call money market funds, and then we have money markets where we are talking about short-term interest-bearing products. Which of them are you referring to?
I'm referring to things like cryptocurrencies and all those. Are they not money markets? Because I seem to have generalized everything. Things like cryptocurrency, bitcoins, and the rest.
I think that is more for or money trading, not necessarily money markets. I think it would be the same concept. Really, it is all based on information. I think the big difference between that kind of trading, if it be it forex or money trading, the big difference would be there are zero-sum games. So, and you trade on margins. Maybe I can explain that. If I'm trading, say, and we do have on our Nairobi Securities Exchange, we do have what we call derivatives. So I'm going to use a derivative to explain that. Now, a derivative is an asset that derives its value from an underlying asset. Is an instrument that derives its value from an underlying asset. What does this mean? It means that there's, let's talk about money in this case. Me and you are trading in dollars. And we both feel that differently. Remember earlier I told you about the emotions and the information that we have. So you think that the US will start to reduce interest rates. And if the US starts to reduce interest rates, it means that even the loans we are paying as a country, even the ability to buy products will cause the dollar to lose some value, which means even our economy will start doing better. And that would also mean that our shilling would start to regain against the dollar. I'm here thinking, okay, this Ukraine war and all these de-dollarization issues may continue to cause the US, and the fact that they're going to print money after they increased their debt ceiling they're going to have a lot of inflation happening in their country. So chances are they'll continue to increase interest rates. How does that affect us? The shilling will continue to lose value. Now, I have a daughter or a son who is going to be going to study in the US in January 2024. And I'm thinking I need to buy dollars. I'll use 1 shilling to 100 shillings to $1 for this example. And I'm thinking I need $100,000 on 1st of January 2025. But I'm worried that the dollar will continue to strengthen. So my 1 million shillings, if the dollar goes from 1 to 100 and goes to 110, I will need 1.1 million shillings, which I don't have. I can go and buy a derivative, or I can go and do a derivative either with a bank, which is, or with you, because you think the dollar will lose value. And we agree that if on 1st of January, the dollar is at 110, you will give me that 10 shillings. If on 31st of January, the dollar is 95, I will give you that 5 shillings. So that way I have locked in that I will still buy my dollars at 1 million shillings out $1 to 100 on that day. So what happens between now and then? If we're doing it on a market, you're going to put your 10 shillings and I'm going to put my 10 shillings. And this settlement will happen every day. If tomorrow the dollar goes up by 1 shilling, 1 shilling will be taken from your account and put in my account. If the next day it goes up by another 3 shillings, another 3 shillings will be taken from your account and put in my account. So now you have 6 shillings in your account. Remember, we are not trading the 100,000 or the 1 million shillings. We're only trading the margin. Now, that's what happens when you're doing Forex. You put a margin which protects you on the gain or the loss of that currency. And then you start listening to the news. The minute they say Trump is standing for president, what do I expect the dollar to do? Then I either sell or buy it. The next day they tell us, oh, Russia has bombed Ukraine. Maybe it will affect the dollar. How will it affect? I don't know. The next day China says they're going to dump their treasury holdings, or they're reducing so that they can buy gold for the BRICS bank. You know, all this information is what you'll be making decisions on whether you're buying or selling the dollar, or you want to go from dollar to yuan or shilling to that. So it's the same concept, a different kind of information, but with currency trading, that 10 shillings you put, you can lose all of it. With shares trading, there's an underlying asset and you own that underlying asset. So even when a company has gone very low, you still have a share which you own. I think that was the best explanation. If Linda, you have an addition to that.
I don't know. I think maybe just from the angle of the funds from a collective investment scheme perspective, where now where you have the option as an investor to buy shares directly from the Nairobi Securities Exchange by opening an account. But then there's also the element of the money market fund. And there are different kinds of funds. So you can have an equity fund or a bond fund. So the equity fund would be you taking your money and pulling with other people and giving this to a professional who's the fund manager, who now invests in the stocks that they feel would give the best return. And then now that return is passed on to you, with how the fund is performing. But yes, so, and with that one, it's affected by the same triggers, the same market news, the same market cycles as if you are investing directly as an investor through the Nairobi Securities Exchange.
Thank you so much for the responses.
Thank you.
Thank you for the question. I'll go to the chats. We have Rose, who's commented and said, I really enjoyed the topic today. Great presentation by Samuel. Kudos. So those are your flowers, Samuel.
Yes, thank you.
We have 2 questions here. Elements to consider before buying a stock, and also the fundamentals. I think it's the same. And how does a brokerage account come about? Where is it created?
Thank you. Fundamentals to consider before buying a stock. I don't think you'll need to be very worried about that. Remember, I mentioned things like market share, profitability, and all that stuff. But as stockbrokers, and again, remember, I'm a stockbroker with NCB Investment Bank. What we do is we have a research function, and we will usually send you reports, and we will tell you why we are valuing Safaricom, or why we are valuing Absa, or why we are valuing this company at this. We'll tell you what the profitability, what we expect to happen, say if they're going into that DRC Congo. You know, we collect information through even visiting companies, talking to their management, doing all the models to get the fundamentals, which is now those profitability ratios, etc. But also based on what we are hearing in the market and globally, what is happening, those issues I'm talking about, dollars and the dollarization, we put all that in a nutshell and tell you we are picking this stock as a good buy at this point in time because of ABCD. So that is where you get the kind of fundamental information so that you are able to understand. Now, remember, we also will hold your hand. We give you someone as your personal relationship manager who you can be talking to. And that brings me to the person who's asking, how do you get a brokerage account? You can approach any stockbroker like ourselves. Please share my number, and we will, you just need to have an ID, a PIN, and a passport photo. We can open the account. When we open the account, we also onboard you on our online platform, so you can buy and sell shares from wherever you are based on the information we shall be giving you through our reports and our research and our support in terms of advice. Somebody is asking money markets, funds, and bonds, which gives you a better return. Money market fund ideally also invests in bonds. They will usually be investing a money market fund, which is also called a fixed income fund, which we also offer, by the way, at NCB Investment Bank. But what it does, the money market fund is going to invest in treasury bills, bonds, and fund deposits with the good and well established financial institutions. Now, all these earn an interest. Now, what happens, as Linda explained earlier, is that this is a managed fund. So you have put your money there, your money has been pooled with many other investors' money, they invest it in these things, and then they give you a return, which at the current time is, I think, is 10%. They will give you 10%, which is annualized, and that is net of a management fee. So they'll charge you a management fee of 2%, but they will promise you that they will give you that 10%. Now, the bond means you're buying the bond directly. To buy the bond, you will need to go and open an account, a CDS, not CDSC, CDS account at Central Bank of Kenya. Once you open that account, you can buy bonds directly. So you're doing the same thing. It's just that when you buy the bonds directly, you're buying one bond maybe, because the minimum you can buy a bond is like 50,000, an infrastructure bond is 100,000 shillings. And once you buy the bond, you can still trade it on the secondary market if you want to, and it can either be in the money or out of the money, but you're doing it on your own, so your ability to diversify becomes less, but your return can be a little higher because you're buying the bond directly. For example, there's a bond that was floated the other day that yielded 14.8%. So you'll be getting 14.8%. You're managing it yourself, so you're not being charged the 2% management fee, but you're stuck with that particular bond. But in the money market fund, they will have so many different bonds, and they will sort of use them to make sure that they can give you a guaranteed return over time and protect your principal at the same time. The difference is that one is passive. You have nothing to do with what is being bought and the investment, and you get a return. The other one is active, meaning you buy the bond, you decide when to buy or sell. Thank you.
Thank you, Samuel. I'd like now to invite Linda to maybe comment on that, and also while at it, give the closing remarks.
Okay, I think, let me just say that NCBA is a licensed broker, because here at ShareHub, we are always telling our clients that when you start your investment journey in the real Nairobi Securities Exchange, you have to create a relationship with a broker, and you first go to a licensed broker. So when Gishoi was talking, yeah, we do all this. So I would like to assure our listeners and everyone who will be watching this even later on that NCBA is a licensed broker. So rest assured they're regulated, and they'll be able to give you the best of service from their end. But yes, so for me, it's just thank you very much to Gishoi for coming through and sharing insights. I tell everyone that even though you've been in the market, I've been in the market, the capital market for 10 years plus, but every other day I'm learning something new because the market is so dynamic. It's changing, you're getting different perspectives from different people. So it's very good when we have such sessions and we're able to share. And we also get to give you, our listeners, an opportunity to share your ideas, your thoughts, your questions. So we get to know how best we are able to relate to you. So thank you, Gishoi, for that very interesting, insightful presentation. We appreciate. I think from my end, it's also to say thank you to everyone who tuned in today, whether you joined the webinar live or maybe watching from YouTube. And again, to just say we'll have the webinar available on our YouTube channel. And we also have a lot of information there as well. So I think I saw questions on how do you decide on a stock, how do you start your investment journey, the brokerage, the whole account opening process and all that. So we are sharing as much information as we can on our channels. So please do stop by YouTube, Facebook, Instagram, TikTok, all that, and you'll be able to get information. I think as a parting shot from me, it's always good to invest some time in before you start investing. Invest time in doing research. Then before you start the real investment journey. And it's very good. I would commend now the people at least who joined, because this is the investment of time that you are doing so that you gain that level of clarity, that level of confidence, that you've improved. And as I said at the beginning, my hope is that how you joined when we started the webinar and now we'll be able to close with you being a more informed investor. And so yes, this is part of investing your time in learning how to invest before you start your investment journey, or you continue your investment journey on a more positive trajectory. But yes, thank you very much. And yes, do take time on financial literacy and share all the information that you have learned here today with those close to you, with your friends, with your workmates, with everyone around you, so that we can be able to build our capital markets and just build ourselves, our families, and our communities at large. Thank you. Back to you, Paris.
Thank you, Linda. And I'll just like to echo what Linda has said. Follow our social media for those who are asking about the recordings. We've been live on YouTube. Follow us on YouTube, on Instagram, Facebook, Twitter, LinkedIn. We are also on TikTok. So follow those social media handles and we can be able to interact more. And so that you're not, you'd get to see the next webinar where it will be, and also give feedback on what areas you'll also want to learn. Thank you, our guest speaker, Bwana Gishohi. It has been very insightful. And for those who are asking for his contacts, if you followed the presentation, he showed it there. Maybe we can pull it up again as we are closing. So for those who want to pick the contacts, can pick as we are exiting. Thank you so much, and see you in the next webinar.
Thank you, Paris, and thank you, everyone. We'll share his contacts as well.
Thank you. Bye. Looking forward to hearing from you.
Nelly, si utoe watu.